Are you a small business owner who has never had a great understanding of your business's financial statements? Maybe you're great at sales but struggle with your numbers. Today, let's dive in to a discussion on what your profit and loss statement is and how to best use it to be more fully in touch with your business's finances. It's a great day to be in business. Welcome back to the channel. My name's Jason Heller. As a lifelong entrepreneur, small business owner, and corporate trainer, I am passionate about business operations, technology, and processes that allow me to use my time more efficiently. On this channel, I share that passion to help other small business owners improve their bottom line through cost-saving tutorials and efficiency-boosting product reviews. Be sure to hit that subscribe button if you're looking for content designed to help you be more in touch with your business, because at the end of the day, it's all about the bottom line. I'm excited to be doing this series on financial reports because I feel like there's a good number of small business owners and entrepreneurs that really struggle with understanding the financial picture of their business and how to use reports like this to make better and more sound financial decisions for their business. Even if you do have a strong financial understanding, I feel like there's always something that we can pick up from each other, and I hope to share a couple of things today that can help you out. So some of the things I had planned for us to talk about today are the value of the profit and loss statement in your business, some of the limitations of this report and where you may have to go to find other financial information important to your business, different accounting methods, and then we're going to kind of walk through some examples of some profit and loss statements from very basic to a little bit more advanced. So basically, a profit and loss statement is probably the go-to report for most small business owners. It can be called a profit or loss statement. Some folks call it a income statement. But the basic premise of this report is that it shows your business's profit or loss for a given time period. So there's an important thing to understand in what a profit and loss statement does not do for you, and that's that it doesn't tell the value of your business. So a profit and loss statement is limited to looking at income flowing into the business and expenses flowing out of the business. It doesn't look at important things to take into account when valuing a business, like assets and liabilities, for example. Those are pieces of information that we would look for on a balance sheet. And we'll be doing a future video that goes over the balance sheet and how to use it best. Another important thing to understand is that there's two different accounting methods for how we keep track of our business's finances. The first is cash-based. The idea of a cash-based accounting method is that you have immediate accounting in your books of your income and expenses. When cash exchanges hands and is paid to you, it's recorded at that point. And when the cash leaves your bank account to pay it, it's recorded at that point. The cash-based accounting method gives you a better picture of cash flow in the business, allows you to manage your business better based on available cash. And the tax implications of a cash-based accounting method is that the income is taxed when it's actually received. Now, the other way to keep your books would be the accrual-based accounting method. The difference here is that the accrual-based method uses accounts payable and accounts receivable accounts to record income and expenses in your books when they're earned, not when they're received or paid. So in the accrual-based method, if you do some work for a customer and you invoice them today, it counts that income today. Whereas in a cash-based accounting method, that income wouldn't be counted until you actually receive payment on that invoice from your customer. So the accrual-based method is used more often than the cash-based method because it is believed to give a better overall financial picture of your business that doesn't follow cash flow. It follows actual business earned and liabilities owed. The downside of the accrual based method is that you have no awareness of actual cash flow. So on paper, you can look quite profitable, but actually have zero cash in the bank. So do you know what accounting method your business is using? Why don't you put it in the comments? Let us know what accounting method you're using and why. So if we talk about the very, very basics of a profit and loss statement, it comes down to this. Your income minus your expenses equals your profit or your loss. So there's not a much more simpler way to explain it than that. But we can add more and more complexity and detail into our profit and loss statement. So we could simply track only income and expenses, or we can add more detail like cost of goods, categories, subcategories, EBIT. And let's go over, some of those things right now. So let's start with the most basic of profit and loss statements. So we're using our fictitious company, AABL Enterprises here. So you see, most financial statements would start with the name of the business, the title of the statement, in this case, a profit and loss statement, and then the period that we're looking at in that statement. In this case, we're looking at January 1st through January 31st. So in this very basic statement, you see it's reporting that we have $10,000 in income and $5,000 in expenses, which leaves us with a net income of $5,000. So in this basic, simple profit and loss statement, it did its job for us. We know how much revenue we've received, we know how much we've spent, and we know what's left over at the end of the day. Most business owners, I imagine, are looking for a little bit more detail in their profit and loss statement than we have right here. So you can accomplish that kind of detail by adding categories. So in this case, that $10,000 in income, now we see that $2,000 of that income came from business coaching that we did. $5,000 was from consulting and $3,000 was from public speaking. And for our expenses, we see that $500 of that went towards advertising, $3,500 went towards travel, and $1,000 for utilities. So we still have the same $10,000 in income and $5,000 in expenses, leading to a net income of $5,000. But by adding some categories in, we just get a better picture of where that money came from and went. And we can go deeper than that even with subcategories. So in this case, you see we've broken down that advertising expense of $500 just a little bit further. So specifically, we spent $400 of that on social media advertising and $100 on SEO and website work. So you can see we could get as detailed as we want and make the financial statement longer and longer and longer to allow us to dive in to more and more detail about our business. A lot of bookkeeping software, besides the ability to add categories and subcategories, allows us to add more detail, such as classes and locations. So perhaps we are doing $5,000 worth of consulting this month, but maybe we want to track the consulting that we did for a specific customer or a specific category of customers. So we can add classes to our transactions to help us break it down even further. So perhaps we're tracking consulting that we've done for universities and for public schools, for example, and we could run a profit and loss by class report to get a further breakdown on our income and expenses. So check out for a future video that goes into some detail specifically with QuickBooks Online in how to use classes and locations to categorize your transactions even further. So the examples we've looked at so far work great in a service-based business where we're providing a service and we're not maintaining inventory. By adding inventory into the mix, it does add a little bit of complexity as well in terms of needing to track cost of goods sold. It's keeping track of the cost of those very items that we're selling to our customer. So in this example here, you see we now have video equipment sales, $8,000 in video equipment sales. So our income, we have $3,000 in consulting, $2,000 in public speaking, and $8,000 in video equipment sales. So this makes our total income $13,000. But what's not counted for until the next line is the cost of that video equipment, what we spent to buy that video equipment in order to sell to our customer. So the $8,000 in sales that we generated from the video equipment cost us $3,000 to purchase that equipment. So we need to take that off of our income line to get a true picture of what our gross profit is before expenses. So in this case, we take that $3,000 cost of goods out, and we're left with a $10,000 gross profit. And then minus our $5,000 in expenses brings our net income to $5,000. But of course, in business, there's other expenses besides these. And this is where EBIT comes in. And there's three different acronyms that essentially cover the same thing. So in this case, EBIT is earnings before interest and taxes. You might hear people use the terms EBITDA or EBITDA, which is earnings before interest, taxes, and amortization, or earnings before interest, taxes, depreciation, and amortization. So the reason this is used is because EBIT is considered to be a better measure of company profitability that's used by investors. So it takes out the variables of interest, taxes, depreciation, amortization, and allows you to do a more apples to apples comparison of businesses in the same category, no matter where they're located. So it's basically used by investors. In some cases, it really provides a more accurate view of the company's real performance over time because it takes those variables out of the financial pictures. So there are different methods for calculating EBIT that are beyond the scope of this video. But let's take an example of what adding EBIT into our profit and loss might look like. But before that, let's just take a quick glance at a couple of definitions from EBIT that I think are important for any business owner to understand, and that's depreciation and amortization. So I think these two terms often get confused with each other, but there's a really distinct difference. So depreciation is spreading the cost of physical business assets over their useful life, whereas amortization is spreading the cost of an intangible asset, such as franchise fees, licensing, patents, things like that. So for depreciation, for example, maybe you purchase $100,000 in display fixtures for your business, and you expect their useful life to be about 10 years. So most simply, using the straight line method, you can depreciate those displays at $10,000 per year for those 10 years. There's another method of calculating depreciation that is essentially an accelerated method where the value of the assets depreciate faster in the early years of its ownership. It's important to understand that these type of expenses, depreciation and amortization, become tax deductions for you come tax time. Now, that example I gave for depreciation, a similar example for amortization. Let's say you opened a franchise business and your franchise fee is $50,000 that grants you a 10-year license to operate that franchise. So you could amortize that $50,000 expense over that 10 years at $5,000 a year, and that would become a tax deduction for you. So if we put all of this into a profit and loss statement, you see the way that it changes some things. The line that was previously net income has now become our EBIT line. So we have our income section with $10,000 in gross profit, our expenses with $5,000 in expenses, which leaves us with EBIT, our earnings before interest, taxes, and amortization of $5,000. But then we add in our interest expenses, our interest income. In this case, we had $200 in interest income. We paid $500 in taxes, and we're claiming $1,000 each for depreciation and amortization, which makes our total other or miscellaneous income and expenses negative $2,300. So that makes our bottom line, our net income, $2,700. So that's how EBIT would come into play on our profit and loss statement. So where we started was this simple profit and loss on the left, which is just simply showing our income and our expenses, and then our bottom line, our profit or our loss. And we've moved to the right where we added in some categories, subcategories, cost of goods, and then some income and expenses beyond the EBIT line to track our interest, taxes, depreciation, and amortization. So that was a great introduction to the profit and loss statement and how it can help you be more in touch with your business, which is our goal on this channel. I plan to do some future videos, specifically within QuickBooks Online, on how you can manipulate and filter the profit and loss statement in that software to find exactly the kind of data that you're looking for. And we can make it look exactly like our simple example all the way to our very complex example. If you find this content valuable, please take a second to hit that subscribe button and make sure you click on the bell so you get notified the next time that we post something just like this to help you make your business run more efficiently and get you more in touch with your day-to-day operations. Again, thank you so much for checking out the channel, and always remember to keep an eye on the bottom line.